Hi everybody, this is George Veter, Veter Financial. Wanted to do a shout out and a little communication with you as we begin the fourth quarter here to give you a state of the market and to let you know my thoughts on how things are going and what we have to look forward to. First of all, I just want to mention how much I appreciate everybody that would be watching this video blog that has been a loyal client. I realize that you have a choice to go wherever you want to go and that you committed all of these hard-won dollars to me to manage effectively and my team, and I never take it for granted and super grateful for your trust in me. That being said, now we're solidly into the fourth quarter, halfway through October here, and as far as how things have progressed through the year, it's kind of been textbook. Those of you that have been my clients for some time know that there is a seasonality historically to the market. The market typically, if we're using the S&P or the Dow, has a flow to it seasonally, not every year, but most years it'll average that we have the biggest struggle in the summer, and then we have the historic best gain opportunities in the fall, and this year's kind of gone to suit. September we were negative on the Dow and the S&P, which we count on September to be a weak month for us. It usually is. Again, those of you that have been clients of mine for years, you know that I preach if you're going to add cash to your portfolios, typically September, Labor Day through the middle of October is a good window to use as an average rule. Since World War II, September has a negative average return, and it didn't let us down this year. That actually helps us as we move into the fourth quarter because it makes prices more attractive in the different categories of equities. And so it sets us up to have the seasonal pattern that we usually roll into that we did this year. In fact, last week, as I'm sitting here on Monday, it was the middle of last week that we got into earnings, and our first spat of earnings were focused on big banks that beat their expectations as a group, and so that created a big pop in the markets that actually we had our best day last week that we'd had since March, and that was based on beating of expectation for earnings. And earnings now, going from middle of October to middle of November, as they're reported, most of them during that 30-day period of time, that launches us solidly into the Christmas buying season. So again, historically, December's our best month, has averaged the highest return since World War II. November's our second highest month, and January is our third highest month because we call it the January effect, and it essentially is a time for people to add money to their pensions, whether it's a 401k or a 403b or a 457. You have a contribution limit during the year, but in January you have a new tax year, so everybody can put money in, essentially. That creates a bunch of money that has to get invested in January and all these different pension funds, so that creates definitely an atmosphere of buying which lifts the market, and we've seen that year in year out, and so the market looks forward to that. So bottom line, we had just the type of summer we anticipated, and we've launched into the fall just the way we would hope for and typically happens, and so we look forward to doing very well between now and the end of the year. Of course, nobody knows what tomorrow brings, but I like the trend. And as far as going forward, we have healthy banks, we have low interest rates, we have a consumer that's coming back from this pandemic, which everybody's excited about on Wall Street, and I'm very optimistic going forward in the near term, in the midterm. And I know whatever challenges we have out there, we will be able to respond to them appropriately and keep accomplishing client objectives. And that's what I'm committed to and grateful that I get to do for you. God bless you with good health and great relationships, and I'll continue to worry about your money for you. Thank you.